Today, we're delving into a selection of top dividend stocks poised for a long-term buy and hold strategy in 2024. Our focus will be on undervalued companies offering attractive starting yields. This comprehensive analysis will include a deep dive into the historical performance, dividend safety, financial metrics, and valuation models of these companies. Additionally, we'll explore Wall Street's outlook, including price targets and percentage upside. Let's kick off with Energy Transfer, a stock that has seen an 11% increase over the past year. Trading at the upper end of its 52-week range, the stock boasts a yield of just under 9% and a forward PE of approximately 12. Over the last decade, the stock has experienced a 33% decline, with its all-time high recorded in 2015. Examining its dividend safety score of 50. Energy Transfer is considered borderline safe with a market cap of $44 billion. During the last recession, the company increased its dividend, although with below-average growth. Notably, its dividend growth has been inconsistent, experiencing a cut in the previous year. However, over the past decade, dividends have grown by an average of 5% annually. Utilizing the dividend yield theory, which posits that a company is undervalued when the current yield exceeds the 5-year average, Energy Transfer appears reasonably valued. Forward PE to DCF is slightly higher than the 5-year average, suggesting the potential for a reasonable valuation. In our valuation model, the intrinsic value for Energy Transfer averages at $18. With the current price at $14, a 20% margin of safety is identified. Wall Street aligns with a price target of $19, indicating a 36% upside. Moving on to UPS, which has seen a 13 to 14% decrease in the past year. Trading towards the mid to low end of its 52-week range, UPS offers a current yield of over 4% and a forward PE of just under 18. Over the last decade, investors would have enjoyed a 58% increase. With a solid dividend safety score of 69, UPS is considered safe, boasting a market cap of $135 billion. Throughout the last recession, UPS maintained its dividend and outperformed the S&P 500. Although its dividend growth was positive last year, at 6.6%, it fell slightly below the inflation target. Considering dividend yield theory, UPS appears reasonably valued, if not slightly undervalued, with a forward PE in line with the 5-year average. The company's free cash flow payout ratio is below the 60% threshold, indicating a healthier dividend. In the valuation model, UPS shows an intrinsic value of $172, providing a 15% margin of safety. Wall Street forecasts a price target of $240, suggesting a 10% upside. AbbVie has witnessed a 7% increase over the past year, trading towards the upper end of its 52-week range. Offering a yield just under 4% and a forward PE of over 14, AbbVie has demonstrated a substantial 224% growth over the last decade. With a dividend safety score of 70, AbbVie is considered safe, boasting a market cap of $287 billion. However, during the last recession, it did not pay a dividend, and its growth during that period was a modest 4.7%. Notably, AbbVie is a dividend king, having increased dividends for 50 years or more. Analyzing dividend yield theory, AbbVie appears reasonably valued, if not slightly undervalued, with a yield higher than the 5-year average. The forward PE is lower than both the 5-year average and the health sector PE. In our valuation model, AbbVie shows an intrinsic value of $173, offering a 10% margin of safety. Wall Street projects a price target of $173, indicating a 6% upside. Lowe's has witnessed a 4% increase over the past year, trading in the mid to upper end of its 52-week range. With a yield just above 2% and a forward P of just under 17, Lowe's has shown a substantial 360% growth over the last decade. Boasting a high dividend safety score of 93, Lowe's is considered very safe, flaunting a market cap of $126 billion. During the last recession, Lowe's increased its dividend above average growth and demonstrated a positive return, outperforming the S&P 500. Dividend yield theory suggests a reasonable valuation, if not a slight undervaluation, with both the forward PE and dividend yield higher than the 5-year average. Lowe's free cash flow payout ratio is comfortably below 60%, indicating a healthy dividend. In our valuation model, Lowe's intrinsic value is estimated at $274, offering a 10% margin of safety. Wall Street forecasts a price target of $240, suggesting a 10% upside. Finally, let's explore ARCC, a high-yielding stock with a yield of 9.41% and a forward PE of under 9. Trading towards the upper end of its 52-week range, ARCC has shown a modest 4% increase over the past year. With a dividend safety score of 59, ARCC is considered borderline safe, boasting a market cap of $11.6 billion. Notably, during the last recession, ARCC cut its dividend and significantly underperformed the S&P 500. Dividend yield theory suggests reasonable undervaluation, with both the forward PE and yield higher than the 5-year average. ARCC's earnings payout ratio is now at a comfortable 81%, showing improvement. In our valuation model, ARCC's intrinsic value averages at $21.89, providing a 10% margin of safety. Wall Street predicts a price target of $22, suggesting an 8% upside. In conclusion, these stocks offer varying degrees of safety, growth potential, and attractive yields. It's essential for investors to conduct thorough research, aligning these findings with their own investment goals and risk tolerance. As always, the market can be unpredictable, so staying informed and adapting strategies accordingly is key to long-term success.